So, another bit of development jargon that you'll often hear thrown around in conversations around the built environment is the idea of a capital stack. And in today's video, we're going to talk about what is a capital stack and how does it impact a project. So, what's stacking up in the capital stack? Capital stack refers to the amounts and different types of equity and debt, effectively money used to fund a project. And so there are really two types. There's equity and then there's debt. Debt is a loan against the project, and equity is cash contributed by investors. On the equity side of the capital stack, you generally have two different types of equity. There is general partner equity and limited partner equity. The general partner has the most risk in the project and often has the most upside. The limited partner is also an equity contribution, but they are limited in their exposure to the risk of the project. So, whereas a general partner might have to sign a personal guarantee backing up the debt, which we'll talk about in a second. So, they're promising if the project goes south, they not only lose their equity position, they might also have to contribute additional assets. They might go bankrupt ultimately. The limited partner has less risk, so while they may lose their entire equity if a deal goes bad, they won't lose additional assets. So because the general partner takes on more risk, they have more upside than the limited partner. What the limited partner is doing is they're contributing their equity and limiting their downside. So they're limiting their downside, but they're also limiting their upside. On the opposite side of that is the mortgage or the debt or the leverage. So where equity is a cash contribution, debt is a loan. So typically a bank will loan money alongside the equity to contribute to financing of the project. The debt also comes with the promise of being paid back, whereas equity doesn't. And the debt is usually securitized or collateralized against the project itself. So in the event that a project fails, the bank will usually take over ownership of the asset or the project. So really the difference in capital stack comes down to the deal terms, how much compensation the party, whether the limited partner, general partner, or debt provider gets in exchange for providing their financial support to the project. So there's the deal terms, and then there's the risk profile and appetite of the partner, right? So the highest risk is the general partner, and then there's the limited partner, they're medium risk, and then the lowest risk is the debt, right? Because if the project goes south, they take over ownership of the project. Because the risk profile changes by the different parts of the capital stack, the returns or the deal terms are different in exchange for their part of the ownership of the project. There's lots of different nuance to that as well, but those are the basic kind of three types, right? You've got equity is type one, type two is debt, and then within equity, you've got general partner and you've got limited partner. And the way that this matters is if you have a project that has a cost of 100 and it goes up in value by 10, that 10, that increase in value accrues to the equity owners of the project, right? So the terms of the debt don't change. They have to, if they borrowed, let's say, 70 of that 100, they still have to pay back the 70. If they've made an additional 10 in value, the ownership, the 30, the equity partners receive 100% of that increase in value. And so, in simple terms, increasing your leverage or the amount of debt as compared to the part of the capital stack that is equity increases your ability to make returns, right? Because in that same example, if you had 90% leverage or 90% debt, the equity contribution would only be 10%. And if you increase the value of the total project from 100 to 110 because the market increased or demand increased or rents go up, then that increase of value of 10 is compared to the original equity ownership of 10. So you've effectively doubled your money if you were one of the equity investors. Again, the bank still gets paid back the 90, that doesn't change, but the equity owners get their share of the upside potential. Now, the reverse is also true. While increased leverage increases potential returns, it also increases potential losses. Because if in that same example where there was 10% equity and 90% debt, so that's 90% leverage, if the value of the property goes down by 10, so from 100 down to 90, your equity is completely wiped out and you've lost everything. The bank still gets the value of their 90 because, again, the project is worth 90, but all of the equity investors have lost everything. So the way to balance that is to reduce leverage, right? So that way, if the project goes south a little bit, loses 10%, you may still have some equity value left over. But again, that's the tension, right? The higher the leverage, the better the potential returns, but also the higher risk and the worse the potential losses. And so there's always this tension with how much risk the investors want to take on and how much upside they're looking to gain. So there's no perfect answer, but that is the capital stack and how it impacts the different types of real estate projects.